This is Scott Becker with a special joint episode today of the Becker Private Equity and Business Minute podcast together with the Becker's Healthcare podcast. We've got the pleasure to talk to the chief economist at Commerce Bank, Scott Colbert. Scott's got sort of a brilliant overall perspective on the economy, on interest rates, on the bank crisis, and so much more. So we thought we'd share his thoughts with both the Becker's Healthcare audience as well as the Becker Private Equity and Business Minute podcast audience. So thank you. Scott Colbert, thank you so much for joining us. Can you take a moment to introduce yourself and tell us a little bit about your role in Commerce Bank?
Sure. My name's Scott Colbert. I'm the chief economist here. I work in the money management area of Commerce Bank. Commerce Bank is about the 40th biggest bank in the country by assets, about the 20th largest bank if you want to measure it by market cap or what it would cost to buy the company, about a $30+ billion regional bank headquartered here in Missouri, but our footprint stretches basically west to Denver, east to Cincinnati and Nashville, north to Des Moines and nearly Chicago, and then south all the way to Houston. That's our geographic footprint, but we do have national businesses as well, including healthcare and a number of services that we provide, particularly payment system, credit cards, things like that, on a national basis.
Thank you. So I'll ask you a number of questions. The Fed raising rates, how far do you see them going? Do you have a sense? I mean, people are predicting the next meeting, another 25 or so. Do you have a sense of what you expect from the Fed? And talk about some of the implications for money management.
Well, I think before March 8th, which was the day that Silvergate and Silicon Valley Bank and Signature Bank kind of imploded, we were in the camp that the Fed would have to do quite a bit of pushing and keep rates higher for longer than the market was expecting. And that pretty much came to fruition last year with, it started with just a 25 basis point increase. But prior to March 8th, the Fed had moved rates up basically 9 consecutive times and pushed rates up 450 basis points from their initial starting point. And so, the market was getting the message that the Fed really meant business on inflation. And inflation, of course, surged more than anybody was expecting, and it was stickier and lasting longer than most people were expecting. So we were kind of in the camp that the Fed would still have a bit of work to do. And we knew there were cracks going to show up somewhere. They probably started in the fall when you got the cryptocurrency collapses. They were beginning to show up in the spring, where you had 3 major property developers let their commercial properties just go because they knew that the mortgages that they were going to have to refinance weren't anywhere near the value. And these were name brand folks, including PIMCO, that just let some properties go. That was probably the second crack to show up. And then out of nowhere, basically the day after, Jerome Powell, our chairman of our Federal Reserve Bank, spoke to Congress and said, we've still got a long fight to go on this inflation front. That literally was the crack that showed up then in the banking system. And so now I don't think that the Fed is going to have to raise rates much more. I think they probably got one more rate hike in them, and then they're going to be willing to sit tight for quite a while and see if that has been enough to really kind of slow the economy enough, if not push us into a recession, and then secondly, see what it does to disinflationary trends. We do believe that they're going to hold that rate up there longer, much longer than the market is forecasting, because if you look at the forward curves for the Fed funds futures, there are 3 rate cuts put into the market by the end of the year. We don't see that coming at all. I think that the disinflationary trend will still be, slow enough that the Fed will not basically take its foot off the brake, if you will, until it sees the whites of the eyes of disinflation pushing inflation down solidly into that 2% camp. And that's going to take a year or two. It's not going to take 3 months or 4 months or 6 months for the Fed to ease up after they've been breaking the economy.
Thank you very much. The next question is, you had alluded to this for a moment there on commercial real estate. Mm-hmm. People are talking about really potentially challenges in the commercial real estate world. And part of that's based on people have loans that are coming due that were financed at one rate, that now that are maybe much higher rate. What's the cases there, particularly some of the big cities end up, in big trouble in terms of people not using the big office buildings like they were? What's your sense of what kind of fallout you might see there?
Well, first off, I'd like to say we haven't had a good old-fashioned commercial real estate recession since 1986. So it's been quite a while. It's been 36 years since this segment has really been brought down. Clearly, the back to work flow to the downtown offices has been much slower to pick up than people might have hoped for a couple of years ago. I might say that over in Asia and over in Europe, the occupancy rates are much better. So this is a uniquely American, kind of situation. But the fact of the matter is that the vacancies are up, and the prices will be falling on office buildings. Since interest rates are up, the cap rates are also up, meaning that basically it's going to cost a lot more money to refinance these mortgages. Many mortgages that carry like a 3% rate. So it's going to be very, very difficult to get refinancing, and this is a trend that will start to build as 2023 progresses, and then a bigger trend that really starts to force its way back to the market in 2024 and 2025. Commercial property prices are going to be falling. That's going to be much more difficult to refinance them. Class A property probably makes it through all this, but it puts a tremendous amount of pressure on anything Class B or Class C, where basically Class C property probably just turns into total vacancies, and Class B property becomes a deteriorating asset. But banks, of course, hold a lot of this property, but so does the CMBS, the commercial mortgage-backed market that bond buyers buy too. This is where these properties are.
And when you're saying big endowments hold this, pension funds, everything else, when you talk about hard to refinance, do you mean hard to refinance in a binary way, or if they were at 3-4%, they'll be refinanced at 8, 9, 10%, which will make them very challenging? Or do you mean just truly hard to refinance some of these?
Well, in general, the refinance is based upon two things: what someone would value the property at, and you get a loan to value of something like historically as much as 80%. In other words, you get a loan on 80% of the value of the property. As property prices are falling and people are backing away, those loan to values are increasing, meaning that that a bank is only willing to lend, say 50% or 60% of a property's value, and those values are falling because, of course, their rents are, if they're not increasing, they're declining because of the lack of vacancies. And the second measure, of course, then is total basically monies that get thrown off by the property after accounting for all of your expenses. And so the ability to service your debt, and typically they trade at about 1.2 times, 1.2 to 1.3 times. You can get a loan up to about, in other words, about 80% of whatever debt service you have the ability to do. But that amount of debt that you can service is coming down. So it's a combination of the higher interest rates, lack of occupancy, that creates a lot less money coming off these properties. And in many cases, it may be that they don't even generate enough money to turn the lights on in the property, literally take care of the depreciation and operating expense. So it's a big problem that we have to work our way through. It's not the subprime crisis, but it's going to be similar to the subprime crisis in a lot of ways for those folks that are long debt to the commercial property sector.
Well, when people talk about there being $2 to $3 trillion in debt that'll come due in the next 5 years or so in that area,
Sure.
Talk a bit about GDP, recession. We've not technically had a recession, but how much of
we haven't even been close to recession. I do get this, particularly from, say, the folks that tend to listen to the right-wing news as much more than, say, the left or the middle news. We were never in a recession last year, even though technically GDP did contract for the first 2 quarters just barely.
If we were not technically in a recession, even if it did contract for a couple quarters, which might have traditionally been the definition of recession, but how much of the inflation in the recession in not having a recession is due to sort of deficit spending, that we're spending as a nation more than we're bringing in? For example, there were periods of time in India and China that they showed very high growth rates, but in hindsight, some of those growth rates weren't as high because they were sort of artificially induced through debt and so forth. What do you see here? How big a problem is federal deficit? And that's not a partisan issue of do we cut spending, do we raise taxes, but how much of like the $1 trillion, $2 trillion, $4 trillion in deficit spending accounts for some of that inflation and some of the growth that we're having?
Yes. I mean, the reason that we were not in a recession last year is absolutely 100% because of all the stimulus that was provided. a year and a half, 2 years, 3 years ago. In aggregate, deficit spending during the pandemic was $5.7 trillion. That's hard to hard to get your mind around what that really means. But as an economy, we were a $22 trillion economy on a yearly basis going into the recession. So to divide 5.7 by 22, and you get about 4 months of economic growth, right? So the federal government borrowed 4 months of economic activity and gave it to us essentially all at once. And that, of course, pushed economic growth up for the next couple of years. And that doesn't even include the help from the Federal Reserve Bank by putting interest rates at zero and quantitatively easing, which generated even more liquidity to push us forward. So absolutely, the reason that we were moving forward very quickly, very fast, with inflationary pressure was all of the stimulus that was provided during the downturn. My only point is that clearly we were not in a recession last year.
No, technically not so, or maybe technically so, but not really, because you've got this growth that's inflated by deficit spending. Yeah. How much does it feel like at times, from an economist's perspective, that the Fed and the government, meaning the Fed and Congress, are on two different paths? The Fed's trying desperately to fight inflation through raising interest rates. They've got sort of this single tool or very few tools to do so. At the same time, the government's engaging in deficit spending.
Yeah, normally they try and row in the same direction. And oftentimes, historically, it's been the Federal Reserve, of course, that moved the quickest, the fastest. They don't have a 435-person partisan Congress to try and get spending bills through. They can move quickly and lower rates. But right now, you've got an opposite situation where the government continues to deficit spend. We're looking at budget deficits of approximately 4%. 4% now of a $26 trillion economy, as you just suggested, is in excess of over $1 trillion a year. That is anti-directional to what the Federal Reserve is trying to do by basically cooling off the economy. And so it makes the Fed's job tougher. To the extent there's any deficit spending at all, it makes the Fed's job tougher to rein in inflation by raising interest rates without creating a recession along the way.
And take a moment on, Chief Economist, we watch in the news all the time some of these stats on what the Fed is doing, what unemployment is doing, what the GDP is doing. What do you watch? Because you do this at scale for a large organization where understanding this is so critical to both the organization and to investors. What are the key things that you watch in your day-to-day sort of watching the economy?
I think it's actually a much simpler story than most people know, because of course rarely do you take 5 minutes to step back and look at it. But the economic activity goes through what I call a COPE, where you've got the cyclical parts of the economy that respond first to changes in monetary policy, and frankly even the slowdown in deficit spending. So the cyclical parts of our economy have been pushed around, pretty considerably. I mean, GM stock price is down 50%, Ford stock price is 50%, U.S. Steel is 34%, and Cleveland Cliffs, a big steel maker, 50%. So the cyclical parts of our economy are declining. You can see it in the price of lumber, even the price of oil at $80 a barrel, while it's up a little bit from its $70 level, is down from its $120 levels that it touched during the rush up. So we watch the cyclical parts of the economy, and clearly across the board they're slowing. Maybe the easiest way to say this is how much are building permits down for new homes and apartments? They're down about 16.5% year over year. So that's the cyclical part, the C, new orders. Now those take longer to slow down because people are still trying to catch up with their lack of inventory and all the stimulus that was provided and low interest rates. But new orders are beginning to fall too. We can see that when we watch the ISM, the Institute of Supply Management's supply side new order index. So new orders are clearly declining, and even the building permits, of course, are new orders. That's the O part. The P and the E, the COPE part, the COPE is profitability, and then finally employment. And profitability is falling. If you look at the S&P 500, just flat out, you look at the S&P 500, profits are down in 2022. Reported profits, GAAP profits, are down about 12% from 2021's level. And on a quarter-to-quarter basis, meaning fourth quarter of 2022, which was the quarter, that we basically have full information on, compared to the fourth quarter of 2021, believe it or not, S&P 500 earnings are down 26%. As earnings start to fall, the reason for that, of course, is margin compression. Your sales aren't growing as fast as your costs are. Margins compress, you earn less. Then it finally rolls into employment. And by the time we finally start to fire people in this country, that is the day the recession starts. So that is not a leading indicator at all. It's a lagging indicator. When we put all this together, there are a group of indicators called the leading economic indicators. There are 10 of them. They've been around forever. They've predicted every recession with about a 1-year warning. In aggregate, they went negative. 8 of these 10 were deeply negative enough to push the whole index negative enough that last October would have said, on average, you have about a year to go before a recession. That happened late last year in October. 1 year from last October is this October. And so if you had to put a fine point on it, somewhere around this October, if you're looking for a recession, is probably the lead time that you're historically going to get.
Phenomenal summary. Thank you. When you talk about personal credit card debt in the country, people are paying an average 20% on that. If you start to see this fourth pillar, employment, going the wrong direction, how much havoc does that have the potential to cause people, given that they've got themselves somewhat extended and maybe a little fragile? Any thoughts there?
Well, the reason that everyone should have been panicked during the pandemic, that 1 or 2 months, was the unemployment rate went from essentially mid-threes to 14.7%. The highest unemployment rate since the Great Depression was only 10.8%. During the Depression, it was higher, but I won't say we were measuring things the same way. I'm quite sure we wouldn't have been back in the 20s and the 30s as we do today. So unemployment is probably the key driver to economic growth. And to the extent that fewer people are employed, that's just less money moving through the economy. And basically, this is what creates the recession. Leading up to that, though, are things that you start to see. Already we've seen some increase. We've seen debt as a percent of income increase. We've seen almost every delinquency statistic begin to get a little bit worse. But in general, it's still surprisingly robust. In other words, credit card delinquencies as a percent of total credit cards outstanding is still, it's still probably only about 60% prior to the subprime crisis back in 2007. Auto loans are still pretty strong, but at the weakest areas, the subprime credits are beginning to weaken up. And then, of course, housing is exceptionally strong because, of course, everyone that owns a house basically has a job and they have a 3% mortgage. So nobody wants to give up their house, and so home delinquencies are very low. But those will begin to turn, and those are leading indicators. They are already starting to turn. But during a recession, they, of course, then they become lagging indicators to the extent that they keep growing as unemployment grows. I'll give your viewers just one little insight. If you want to play economist at home, really all you need to know is to guess how many jobs are going to grow next year and how much more money you're going to get paid. Now, to do that, you have to know how many jobs there are. And there's about 155 million jobs in this country, okay? 155 million. Last year, we created 4.8 million jobs. So divide 5 by 150, you get about a 3%, increase in employment, right? Average wage and salary grew 5%. So there was 8% more money coming into the economy, 8%. This year, that employment growth is likely to slow. Now, if it slows to zero, then of course there's no employment growth. You might still get wages. But if employment goes backwards, you can see how quickly then the amount of money flowing into the economy begins to slow down and slow economic momentum.
Thank you very, very much. I'd be remiss not to ask you a little bit about the banking crisis.
Yeah, sure.
Silicon Valley Bank sort of goes down, Silvergate goes down, Republic Bank is in trouble, or depending what day it is, Credit Suisse, which has been sort of a real challenging situation for years. What do you see? What do you see over the next 6-12 months in terms of the banks, and how much does that also impact, credit tightness and credit crunches?
Well, first, let's the one thing that most of these banks that got themselves in trouble so far have had in common are kind of three things. Number one, these banks exhibited tremendous growth during the pandemic. Silicon Valley Bank literally, increased from a $50 billion bank to a $200 billion bank. And when you look at the other banks, they grew defaulted. And of course, the banks that are actually under pressure right now today, too, when you look at the stock prices, they exhibited tremendous growth. Well, fast growth means that they probably had to buy a bunch of bonds with that extra money. The problem with buying a bunch of bonds when interest rates are going up is the prices of all those bonds have come down. So that's the second part of this is that, the fast growth led to big bond portfolios with big losses in the bond portfolio. Secondly, their deposit base wasn't sticky. It might have been narrow in cryptocurrency, but basically the deposit base wasn't diversified, from a geographic and from a business perspective. So it makes the deposits, pretty easy, for them to disappear. Then, of course, the third thing that they all had in common then was basically they had an asset and liability mismatch where the bank's assets, which are their loans and their investments, they couldn't liquidate them quickly enough to give back the money to their liabilities, which is their depositors. So that's the banking crisis in a nutshell. Much different than the subprime crisis, which was all credit driven. This is all interest rate driven. Ironically, you could say the Federal Reserve drove these banks into a situation, and the bank's own mismanagement, complicated, the whole situation to create this run on the bank kind of situation.
No, and what you're talking about is less credit risk than duration risk, and that causing the risk. But to the credit of Chairman Powell, he did a pretty good job of telegraphing to banks that this is where he's going.
Right. You had to listen, and you had to believe him. The market actually didn't believe most of what the Fed was saying. The market said the Fed will never be able to take rates up this high. The market generally, obviously now in retrospect was wrong. They were able to take rates up this high. But there were going to be cracks showing up, and to an extent that a bank mismanaged its assets and liabilities, it found itself in trouble. That doesn't mean that the normal banking cycle won't ensue down the road where credit becomes a problem. And already, we're getting what the Federal Reserve wants, which essentially is financial conditions are tightening. All of the banking system in general now is much more cautious about making its next loan. Many of the banks, particularly the smaller banks, don't even have any money to make these next loans. Credit spreads are widening, meaning the cost that you're being asked to pay, borrow money now, is moving up relative to Treasury rate. And of course, the Treasury rates have increased much more than doubled, in fact, some cases tripled. The 2-year Treasury was literally just basis points before the Fed started raising rates. And now, of course, the 2-year Treasury is north of 4%. All this is working its way towards the normal credit cycle. But this is the first time in a long time that banks have gotten caught on their asset liability mismanagement side too. Last time this happened was really back in the 80s, and it's not surprising. That was when the Fed was raising interest rates aggressively once again to push back on inflation.
So one more question, because you keep on saying interesting things. The 2-year Treasury trading at about 40, 50 basis points lower than the 1-year Treasury is sort of inverted based on, of course, people's expectations that at some point the Fed will have to take rates back down. Do you think at the end of the day that 2-year is not going down very quickly? I mean, that the Fed's not going to be able to, they're going to keep rates up for another year plus unless something really disastrous happens? What's your sense of that? Do you have a feel for that?
Yeah, I almost have a feel like the bond market is well ahead of the economic cycle. When you think about it, the stock market seems to be behind it, unwilling to believe that there could be a slowdown ahead, whereas the bond market is almost over predicting, the slowdown that's coming. Right about the Fed holding interest rates up higher longer, there wasn't really going to be a reason for the 2-year Treasury to trade as far through cash market as it is. But I will say when the 2-year Treasury got to be lower yielding than the 10-year Treasury, or the 10-year Treasury got to be lower yielding than the 2-year, now of course the 2-year is even lower yielding than cash. That yield curve inversion is one of the 10 leading economic indicators that we talked about. It is probably the most, predictive of all the leading economic indicators. When the 2-year Treasury was trading at a higher rate than the 10-year Treasury, it started last July. That also gives you about an 18-month head start to a recession. It's been trading that way and inverted. It's the third worst inversion that we've ever had since 1981. And that would typically suggest, a recession about 18 months after it started. 18 months from July of last year would be January of 2024. So when people ask us around here what our economic forecast is for a recession, sometime starting between October and January of this coming year.
Thank you, Scott. Can I indulge me for one more question?
Sure.
So when you look at Fed Chairman Powell, he obviously a ton of quantitative easing and bringing the rates down during the pandemic. now a ton of quantitative tightening. Like all Fed chairmen, at some point, he's going to take criticism. He's already taking it some, either for too much easing during the pandemic or too much tightening now. How do you sort of grade out his performance? How do you look at that?
There's a lot of folks that really want to beat up on the Federal Reserve. And they did yeoman's work during the subprime crisis and actually did tremendous work during the pandemic. If you want to fault them for anything, it was probably that the way that the CPI works, the CPI has 25% of it is single-family housing, 30% of it is housing in general, including apartments and insurance costs and things like that. The way that the CPI reflects housing costs works with a big lag. And so we were all kind of lulled into a sense of complacency when the market was taking off basically about, May or June of 2020, after all this stimulus was put into the market. The inflation statistics were very benign for the first year. When in fact, everybody and their brother knew that housing prices were increasing. In fact, the home builders index peaked in late 2020, okay, when interest rates were literally, zero. So, I think that they were a little slow on the uptick to recognize the inflation. They, of course, thought it was largely transitory, so they missed that. And because of all that, they kept interest rates lower longer than they needed to. And the reason that they got lulled into that was because post the subprime crisis, they kept trying to raise interest rates and then said, we really don't need to because there's no inflation. We really don't need to because there's still some unemployment. And so they managed to go, 12, 13 years where they were in the mode, boy, it doesn't really seem to help at all to raise interest rates. And even if we do, there's no inflation to fight. They got caught on the other side of this. They basically got whipsawed. So that would be the criticism we ought to have, is that they should have recognized that the inflation problem was creeping in faster and they should have reacted sooner. But once they did, I think that they've borne the heat, right? They're bearing the brunt of Congress that's going to yell at them as unemployment begins to increase and the economy begins to slow. And as they take the blame essentially for a recession that they are creating because they're raising interest rates in an effort to slow inflation. They're in a pickle, and I think they're willing to take the heat. That's why I also think that you're going to see the interest rates stay higher. They honestly believe that a lower inflation rate in the long run is much better for economic productivity in the long run, and they're willing to take the short run hit of a recession, to help us get there.
Thank you, Scott. I know I've kept you much longer than I expected, but it was so interesting to get just to visit you and hear your thoughts. Scott Colbert, Commerce Bank Chief Economist, thank you so much for joining us today on the Becker Private Equity and Business Podcast. Thank you very much.
Thanks for having us.